Nvidia's market cap has now crossed over the 2 trillion mark. It is up 262% over the last 12 months, and we now have analysts extending their price target upwards of nearly 1,400, which they see the market cap rising to around 3.5 trillion, making it higher than the current market cap of Microsoft. In today's episode, we're going to find out whether or not it is still a strong time to add to this company, which continues to grow. We're going to run into their company overview, taking a look at a lot of information to see where the growth is coming from this very strong and rapidly rising company. We also want to discuss some of the free cash flow metrics, as well as some very, very strong metrics that we see Nvidia improving, even though they have already increased very strongly. We also want to touch upon some insider selling. Now, we want to really go back to when the CEO, Jen Huang, did sell shares around 6 months ago and discuss the relevance of this for the company. And what we also want to do is we want to run it through the valuation model to get to our intrinsic value in our acceptable buy price. But we want to look at 3 different scenarios. We want to look at a low scenario, a mid scenario, and ultimately a very high bullish case to see how much growth Nvidia can really have, and if now is a great time to continue to add for this company. Now, just a quick update. This is a company that is up 262% over the last 12 months. Over the last 10 years, up an incredible 17,826%. It is trading now at its 52-week high with a yield of 0.02%. And as we mentioned, it has now crossed over a 2 trillion market cap. So before we do a deep dive, let's take a look at their latest PowerPoint presentation that they did release and try and understand what the application is here for strong growth continuing into 24 and 25. So straight away they talk about how their computing platform has attracted the largest ecosystem of developers, supporting a rapidly growing universe. We can see developers over just the last 3 years more than doubled from 1.8 million to 4.7 million users. We can see the CUDA downloads more than double. The GPU accelerated applications, as we can see, very strong performance, more than 4 times over the last few years. And the AI startups, again, lots of growth that we're seeing here with the use of Nvidia's applications. On top of that, huge ROI, return on investment from AI, driving a powerful new investment cycle. We can see the different applications that they do believe this company will be able to take advantage of in the future, as well as what they are taking advantage of right now. It doesn't just extend to certain parts of the ecosystem. We can see search and social media, AI content creation in terms of vehicles. We're looking at the financial services industries. There is a ton of different applications for Nvidia. Now, there's also the enterprise system in terms of the different areas. We have the AI platforms that I'm sure you would have heard of a few of those. Snowflake, which in fact we recently covered on the channel. We have public cloud marketplaces, AWS, Google Cloud, Microsoft. We have the delivery systems, Deloitte, some really well-known companies here, Accenture. And then what we really want to point out is, and we will take a look at that further, is the increase in their numbers, which are the most important. Their FY20 revenue was sitting at around just under 11 billion. Fast forward 5 years, FY24, 61 billion. So over 6 times growth, or just under, in fact, 6 times growth over the last 5 years. We see a nice increase up to FY 2022, and then we do see it flat, but from then it really did increase, and we'll discuss why very shortly. In terms of their operating income, now it isn't consistent increases year on year, but over that long term, I mean, we're talking around 10 times growth to that operating income over the period. Very, very strong. And what they've also been able to do, as we always discuss, is important if a company can not just increase their top line, but also their operating efficiency, that margin going from 34% in FY20 to 61% in FY24. So lots of positives to note there. And what we can see, in fact, as the main driver behind this growth from FY21 to FY24 is the data center. We can see that go from 40% of FY21's revenue to 78%. So a lot of growth in the company, but again, we can see a lot of that being distributed to the growth in the data center. Now, we'll come upon that very shortly, but we also want to take a look at what we believe to be a very strong metric, the free cash flow. They've also increased that 4.3 billion in FY20, going to just under 27 billion in the latest annual report. Again, we can see a little bit of inconsistency over the last 4 years, or in fact FY20 to 23, but it really did skyrocket in FY24, 27 billion. On top of that, they did share repurchase, as we can see, 9.5 billion in FY24, and they also have a huge allocation, 22.5 billion to end of Q4 2024. On top of that, they do pay a dividend. We can discuss that. It is very small for this company. And finally, what we wanted to point out, a big driver in the growth of their revenue is that data center. They are the leading accelerated computing platform and the number one in AI training and inference. Now, it's gone from 3 billion in FY20 to 47 billion. Again, a huge growth. And the interesting thing here is that management and Wall Street clearly do not believe that growth has finished just yet. And we'll take a look at some predictions to get a full understanding of where this company truly could go in terms of the share price and the metrics themselves. Now, one thing we didn't cover is that bottom line net income. Whilst we saw, as we can see here, the total revenues increasing very strongly over the last few years, we also saw the operating income increase very rapidly. But what's also important to note is that the bottom line has also followed suit. 2.8 billion in 2020, going to just under 30 billion as well. So it's nice to note their operating income has increased 10 times, and in fact their bottom line has followed that pattern as well. So very, very, very strong growth on the bottom of the company. Now, also very quickly for the balance sheet, we have looked at this before, but just to reinforce the fact that they have a very strong balance sheet, it went from 11 billion of cash in 2020 to just under 26 billion in their latest report, which was already sitting at a very large amount. And interestingly, their total debt, both numerically and directionally, whilst it increased quite rapidly as well from 2.6 billion to 11 billion, is still below their total cash amount. So there is no worries with this company in terms of their balance sheet. And we can look at that net debt to EBITDA metric to get a refresher. Also, for those that are interested, to compare it to companies like Broadcom, who have also had a very, very strong last few years that have gone under the radar now due to Nvidia's performance. I mean, over the last year, with those dividends reinvested, Nvidia is up 263%. Broadcom is up 141% and AMD up 159%. So whilst they have had very strong performances, Nvidia has blown them out of the water. And when we look and expand that over the last 5 years, I mean, Nvidia up 2018%. No other company comes close. But what I do like to keep reiterating is that past performance is never an indicator for future performance. So always bear that in mind. Now, before we run through the insider trading that I want to discuss, is notably the CEO sales. With the institutional ownership, it is 65%, and we do see a lot more buying than selling with institutions. Largest buyers coming in Q2, but we also note in the more recent quarter, Q4, institutions were buying more than they were selling. Now, what I wanted to point out from the institutional, or in fact insider buying and selling, this is a buy and sell screener, and we can see over the last 6 months there have been no buys. Now, the reason why I wanted to point this out, typically I just like to look at the last month to gain some more relevant data, but what I was interested to know is when was the last time that the CEO and president started to sell, and we can see that was around 6 months ago at the beginning, or in fact the middle of September. Now, the reason why I wanted to point this out, since then he hasn't sold any shares. And also, what I always like to mention is that insider selling is never a bearish signal. It isn't the greatest, but we can always see that insiders sell for many reasons, personal or financial. And what we wanted to point out here is, since all the insider sales, in fact, every single person has sold, the share price since that point of sale has gone up. 29%, for example, for Michael, the director, who sold at around 636. And the CEO, when he last sold his shares, he sold at around $455. It is up 81% since then. So always take insider selling with a pinch of salt. It isn't the greatest news when you look at the CEO back in September sold a massive amount of shares. But again, something just to bear in mind, and it is something we like to look at when we use our investment thesis. So what we want to very quickly look at before we jump into the valuation, as this will impact the numbers, is looking at the free cash flow per share. Now, free cash flow has been on an incredible run over the last 10 years, going from 36 cents to $10.90, and it doesn't look like that increase or that train is going to stop anytime soon. They are expecting nearly a 100% increase to that free cash flow to $21 in 2025 or FY25, which is their annual report ending in January 25. So do remember this, because we will discuss this and we use this as an input example when we look at the free cash flow analysis and the valuation. We can also see just percentage-wise their top line has increased very strongly, double digit nearly every single year. The more recent year, triple digits, 126%. We also can see the growth if you want to go as far back as 2015, under 5 billion to now 61. And they have slightly diluted your position over the longer term. But again, when you incorporate the share price increase that was very rapid, you probably wouldn't really care given how much that would have affected you very minimally. One thing though that we do want to point out, as we did look in the presentation, they are expecting to do a lot more share buybacks this year as well. When we look at the ROIC, what I like to see is 10% or more. If you want to be industry specific for semiconductors, around 12%. What this gives me faith is that management are able to effectively allocate their capital well above the 10% for the majority of the years, 61 in 2024, looking incredibly strong. Now, operating margin and free cash flow margin, no worries here. But what I want to say, and that we looked at in the investor presentation, their operational efficiency is increasing around 54% in the latest year. Absolutely phenomenal, especially if they can keep this up. Likewise, free cash flow margin, which was already very strong and above the minimum 5% level, 45% in 2024. Finally, what I wanted to point out here when we were looking at that balance sheet, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, is 0. Now, this correlates to the dividend safety, but not really much to discuss here given how small it is. More importantly, the balance sheet strength. 0, it means the number of years it would take them to pay off all of their debt net of cash on hand. Wouldn't even take them one day over the last 10 years given how strong their balance sheet is. Now, before we do jump into the valuation model, just to let you know that we have released our latest free weekly article. If you want to gain access to this as well as all the other ones that we have done over the last few weeks, all completely free, just click on that pinned comment below. Now, the valuation model, typically on this channel, we do run through all the models we go through to get to the intrinsic value. For today's episode, and in fact for Nvidia, it is just made up of the discounted cash flow. So what we've done here is we've inputted the free cash flows year on year, the average growth rate at 30%. With a discount rate, what we would do is we'd get the present value of future free cash flows, add with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get to our intrinsic value. Now, this really derives from the growth rate that you see over the next 10 years. And as we can see here, it really does come down to that. So what we would typically do is we'd use roughly what analyst targets or management and then go a little bit more conservative. What we saw, they are expecting a 100% growth rate next year. Now, if we were to put this just as an educational point, we would see the intrinsic value go up to 8,400. Now, the reason for this is it is extremely unrealistic for a company to increase their free cash flow 100% over the next 10 years and beyond. So if we were to use, for example, the average growth rate over the last 10 years, considering that this company is getting a lot stronger, you'd get to an intrinsic value of $201. So this is where it really comes down to what you're expecting over the next 10 years. What we used in a previous episode was around 52%, as we were looking at the lower level of the being conservative, and that would get to $753. So if we use that at a lower point, as let's say a low case scenario, 52% would be around $754, which we would see here as an overvaluation signal. Now, if we wanted to go for a midpoint around 55%, what we would get as the intrinsic value would show still a sign of undervaluation, in fact, just under a 10% upside to the current trading price. Then if you wanted to be a little bit more optimistic and go for around 60%, we would see an intrinsic value still showing a lot of sign for growth, even at the current trading price, in fact, just under 50%. So it really does come down to what you see over the next 10 years that this share price could be. But realistically, what we saw was around 52%, and that is something that we will use to get to our final analysis. So remember, there are different scenarios. It really does come down to what you're expecting that free cash flow growth to be over the next 10 years. Yes, they're anticipating around 100% into FY25, but that is unrealistic to have that expectation essentially for the next 10 years and beyond. We've gone for 52%. You did see the analysis for 55 and 60. Again, it comes down to the investor. What we would then use would be a margin of safety of 10%, and we would use this if we believe the company has a wide moat, strong financial metrics, and good forward-looking data. If you believe that, the acceptable buy price would be around 6, 7, 8. If you wanted to go further, again, it really does depend. And you can always grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and your watch list, or even if you want to run through Nvidia but on your own terms, estimates and judgments. So what we can see is right now we see, based on the 52% discounted cash flow growth over the next 10 years, we see this trading at higher than its intrinsic value. Now, overall, Wall Street are continually increasing their price forecast as the price increases. This is why I always say, always take what they say with a pinch of salt, as every time the share price of a company goes up, they tend to revise their price target up as well. Right now, they see a price target of $984 with upside of 20%. But we did mention there are analysts who are giving very high bullish targets of $1,400. And in reality, that would make their market cap $3.5 trillion, which would make them the largest company with the largest essential market cap over Microsoft. As always, though, I'm keen to hear your thoughts on this episode of Nvidia. Do you believe that it should realistically have a free cash flow target of more than 52%? Do you believe that the 100% that they're targeting for next year is something they can continue? Interested to hear. And also whether or not you are continuing to add, holding your shares, or maybe stepping aside for this company. As always, hope you have a great day. If you enjoyed this episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you on the next one.